Risk management guidelines. These guidelines provide a set of best practices for establishing and implementing effective risk management in Islamic financial institutions. Principles and risk categories. There are 15 principles of risk management underlying the business objectives that Islamic financial institutions may adopt. These 15 principles are divided into the following 6 categories of risk: credit risk, equity investment risk, market risk, liquidity risk, rate of return risk, and operational risk. Risk management principles for associated categories. The first category, credit risk. Credit risk includes the risk arising in the settlement and clearing of transactions. It is defined as potential that a counterparty fails to meet its obligations in accordance with the agreed terms. The credit risk is applicable to institutions that have financing exposures to receivables and leases, for example, murabaha, diminishing mushaka and ijara, and institutions who are managing the working capital financing transactions and projects, for example, salam, istisna, or mudaba. Second category, equity investment risk. It is the risk arising from entering into a partnership for the purpose of participating in a particular financing in which the investor shares in the business risk. Third category, market risk. It is defined as risk of losses in often on-balance sheet positions arising from movements in market prices. It's related to the current and future volatility of the market values of specific assets. For example, the commodity price of a salam asset, the market value of sukuk, the market value of mudaba assets purchased, and foreign exchange rates. Fourth category, liquidity risk. It is the potential loss to Islamic financial institutions arising from their inability either to meet their obligations or to fund increases in assets. Fifth category, rate of return risk. Institutions are exposed to this risk on their overall balance sheet exposures. The rate of return risk differs from interest rate risk, as institutions are concerned with the result of their investment activities at the end of investment holding period. Such results cannot be predetermined exactly. And the last and sixth category, operational risk. They arise due to processes, people, and systems, and reputational risks arise due to failures in governance, business strategy, and processes. To counter them, institutions should assure soundness of operations and reliability of reporting.